to Neera. Neera, take on.
Thank you, Nidhi. And guys, good morning and welcome to this. I'll make a very, very quick, small intro and leave the floor to Sen, who is incidentally just released a strategy report today, giving his views in terms of the market and the economic outlook for 2024. Uh, we are fairly constructive, on the economy, not only necessarily for 2024. So rarely over the last 15, 20 years, if you look at the key variables that defines the macroeconomic stability, you talk about contained inflation expectations, stable interest rates, very benign current account deficit, gradually moderating, rupee depreciation. So these are very, very powerful building blocks that sets the stage for sustainable growth rate. I think we are one of the very few economies that have actually seen GDP upgrades, right? And the earnings are in front of us. They've doubled in the last 3 years. First half, the earnings were up by 30%. The markets eventually get driven by, how your earnings are defined, how your capital productivity moves. If I'm not mistaken, SAN is a target on Nifty, which is about 10% higher than what it is. We are also probably, fairly non-consensus in our view on the SMID category. We like the mid cap and the small cap space, despite the run that we have seen, and we are saying this with a sense of responsibility. But we do see democratization of earnings, and many companies are participating in this growth rate. This is not to say that we'll not have corrections along the way. Markets rarely move up in linear fashion. We also appreciate the fact that probably 2023 was the 8th year of consecutive gains in Nifty. But we are not a great believer in reversion to mean just for the heck of it. Economic momentum is very strong, but so is political momentum, right? And from what we know about this political party, they don't feel shy of using their political capital, right? So reforms will continue and stuff like that. So I'll just leave this floor to Sen. He'll take you through, in more detail about what he thinks about the markets, and you can obviously he can take questions from you later on.
Call has been forwarded.
Thank you, guys.
Thanks, Neera. Thank you so much, and for that succinct introduction. This is the summary of the slide that of the presentation that we are going through. As Neera spoke about, we are constructive on the markets. We believe we have a Nifty target of 24,000. More on that later. I'll go through all these points slide by slide. But we are constructive on the markets. We have some differentiated views as far as sectors are concerned. We prefer SMIDs to large caps because that is the nature of the recovery in this cycle. For FY24 and 25, we don't see a major risk to earnings. There may be a little niggles here and there, but we don't see a risk to earnings. Next slide, please. So here are key themes for 2024. At front and center, obviously, are rate cuts. We see middle of the year rate cuts by both the Fed and the RBI. This is a slightly different rate cycle from previous ones because it looks more and more unlikely that the rate cut will be preceded by a major economic slump. So, as I mentioned in my note, both India and the global economy and the US economy especially will be going in kind of hot into this sector, into this rate cutting cycle. Therefore, the normal trigger that you get when rates are cut, that there is a revival in growth in economic growth. That is unlikely to play out because, as I said, we are going into the cycle, on a relatively strong economic footing. And in India, anyway, the relationship with rate cuts and a revival in growth is weak. Meaning, it's not. I mean, it is there, but it's relatively weak. Uh, so it will manifest itself more in terms of FI flows and more on that later, and valuation re-rating. It's a fairly simple construct that valuation re-rate. But we don't think it will impact the Nifty valuations that much because some of the Nifty stocks, there are growth issues. Some of the Nifty stocks are already at high valuations. But SMIDs, it will be much more pronounced because lower rates actually impact uh, stocks with longer runways of growth, and where cyclical growth is fairly strong, and that's more manifesting itself in the SMID, small and mid cap. By SMID, I mean small and mid cap. We expect record FI flows in FY25, and that is a big call that we are making. The previous record was FY21. And one of the factors is that, we tend to look at FI flows in terms of, or FPI flows in terms of absolutes, but the opening market cap matters. And, we in FY21, we got those flows on the back of a much smaller market. Now the market cap is much higher, and therefore the absorptive capacity, and also now, the India's share of emerging market flows, because of the troubles that China is going through, is much higher. So if there is a risk of, and there are increased emerging market flows because of weakening rates, then India should get a much higher proportion, and we therefore expect FY25 to be a record year for FPI flows. The second theme is the reform-oriented budget in July. We are building in a comfortable BJP win in the election. We are, that itself will trigger some upside, but we don't, I think that will be priced in much sooner. The budget will be the defining probably document for the next 5 years. And we expect a much sharper, even sharper focus on infra and manufacturing. That is the theme. We believe this is the global geopolitical situation, supply chain alignments, and are aligning in India's favor as far as manufacturing is concerned. This government seems to be intent on promoting that. So we think that there will be more done on that front as far as manufacturing is concerned. One slightly left field view that we have is that post-COVID, mass consumption has not revived. And if you look at a lot of sectors that are dependent, FMCG is one, where which are dependent on mass consumption, they've struggled in terms of growth. We think that this year there could be a revival. The problem is that there's been no satisfactory explanation as to why the weakness happened. Everybody has their own theory, but there's been no satisfactory data-driven explanation as to why the weakness has happened. So it's difficult to put, thumb the table and say, yes, there will be a revival. If you don't know what caused the slowdown, it is difficult to predict. But there are some positive signs. Incremental stresses like inflation and indebtedness are weakening. The election should provide a stimulus. It usually does. And the only hard data that we supports our thesis is that entry-level motorcycles have revived quite sharply in the last few months. So we think that is a sign that economic stress at the lower income groups is easing off if they're willing to either by loan or outright willing to buy a large ticket item like a mobile. And therefore, it is, probably there will be a revival in mass spending. We are saying that given how the stocks have been beaten down, it's not a bad idea to take some exposure in that sector. Next slide, please. As far as the market outlook is concerned, we have a Nifty target of 24,000 for FY20, end of December 24, which is about an 11% return. We are valuing it at historic mean valuations and not, above historic mean, because while there is, and this is a 5-year mean, there are positive factors like lower interest rates and rising ROEs. By the time we get to the end of the year, we're looking at FY26. These are, there are some risks to those earnings. Financials, and I'll come to that later, are under pressure. So we were a little conservative in that. We are predicting an 11% return. We believe that SMIDs will outperform Nifty this year, and that's because this market cycle is being led by manufacturing and capex. Therefore, industrials and sectors that are exposed to that cycle are more in the mid to small cap region. In 5-7 years, we think that the composition of large caps will change more in favor of manufacturing and away from services. But at the moment, we are very services heavy, and this is essentially a manufacturing cycle. So therefore, SMIDs will continue to outperform Nifty. And as Nirav was alluding to as well, in the pre-COVID decade, the earnings growth was concentrated only among a few large cap companies, right? There's enough analysis of data to show that profit was concentrating among. We've done some work if you refer to our report, both our reports in October and now, to show that this is getting democratized, right? The number of companies, for example, showing more than 20% growth, if you take the top 500, is much higher than it used to be. Take top 250 actually, is much higher than it used to be. So, there is a very strong case for democratization of earnings. The market has a wider universe to choose from if you're filtering out for certain high quality metrics. And therefore, we think SMIDs will continue to outperform the Nifty. As far as sectors, we are overweight on consumer discretionary. That's essentially autos. And especially two-wheelers. Within autos, we prefer two-wheelers to passenger and commercial vehicles. But we are constructive on the entire cycle. I think the cycle will last a little longer than most people think. We are overweight on materials, especially cement, because infra and the property cycle are both very strong. And if you want to play this through large caps, then materials and cement is a good way to do it. The big contrarian call is that we are underweight on financials. We think that growth and ROE challenges. Financials is perfectly priced in terms of price to book. There's no re-rating driver. Those who are looking at historic charts are missing the point that from history, both growth and ROE are at much lower levels. And therefore, the fair value multiples have contracted. And where we are trading at is fair to maybe slightly higher than fair. So in a positive market, these are more defensive stocks than outperforming stocks. And therefore, we are underweight on financials. We are underweight on IT as well because IT, if you look at the last 5 years, you make money when the stocks re-rate, when the PE changes. The earnings growth itself gives you very weak compounding. And therefore, to make money in IT, you've got to wait for the right valuations, and which is not the case right now. They are not, valuations are not on your side. So I would wait for better valuations on IT. Next slide, please. Final slide, I think this is the Nifty FY25 growth looks achievable. 26 is dependent on materials and banks. And I think, anyway, consensus estimates, and these are all consensus estimates. Consensus estimates tend to start positive and get downgraded over time, especially on large caps. So we see a risk to that number. Nevertheless, even with that risk, this is a newfound consistency in the EPS growth. I think this is the first time in 15-20 years that the Nifty is set to deliver even a double-digit EPS growth over 3 years. And over 3 consecutive years. We were looking at that, and then I think FY23 turned out to be a bit of a disappointment. So that is certainly one thing to look out for. ROEs are also consistently rising, and we are looking at probably the best ever ROE for the Nifty as a whole in a couple of years, and that will manifest itself in evaluation. So these are all reasons to be constructive on the market. This is more a 1 year and 3 year market view. I have not covered some of the tactical issues. There's one point I missed out on. If we can go back a couple of slides. Yeah. Next one. Sorry about that. Yeah. So we are while we are projecting an 11% return, we are looking at what I have called the dashboard shaped return. First and fourth quarters will be relatively anemic. First quarter because we outperformed so strongly in the fourth quarter of 23 that the market will consolidate and take that in and pause for breath. Second quarter onwards, all the triggers start to kick in. We are going to see the elections, rate cuts, and the budget. The three major triggers for the year all play out from somewhere between April and September. And by September, all of that would have been priced in, and we'll probably see another week close to the year. So just as Nirav said, markets are not linear. And we expect that if you break it up quarterly, that most of the returns will come in the second and third quarter of this calendar year. That's it from me. I will pause here and take questions. Over to you, Nidhi. Thank you.
Thank you, Nishaji. Anybody who has a question can raise their hands or also put it up in the chat or Q&A. So Bharat has a question. Amit, if you could unmute him and let him talk.
Yes, Bharat, please go on.
Yeah, so I have a couple of questions to Mr. Sheshad Nitin. One, the big call on financials and IT. Over the last couple of years, financials, pockets in financials were in favor, and the rally, earnings-driven rally continued. But this quarter, there have been, even before the quarter, there were reports that said that NIM moderation could be the thing going forward. And we saw numbers from HDFC Bank which spooked the markets. Now, my question is, with the two biggest sectors that drive the benchmark indexes, IT and financials, that you're underweight on, and earnings likely to not show that strength that they showed in financials, and IT earnings probably will take some more time to pick up. And your other factor is the rate hopes by mid 2024. Any further delay in rate hopes, or if the earnings do not come through from these two sectors, do you think that there could be some pressure on the benchmark in the first three months to 4 months, and then with the election results as well as earnings picking up in IT and the like, could we see the Nifty bouncing back? I just wanted to get a sense on how the two sectors that drive the index probably provide directionality to the index. You're underweight on them, but you believe that the constructive on an overall basis on the markets. Could you please elaborate on your stand, please?
Yeah, I think collectively they are still less than 50% of the index. So meaning logically, if I'm underweight on 50-60% of the index, if you had that's fine. I'm underweight. I'm not expecting them to fall. So they'll underperform the index. You're absolutely right. As I said, we are expecting dashboard-shaped returns. So the returns will be punched in the second and third quarter. The first and the fourth quarter are likely to be relatively muted. As far as financials is concerned, yes, this will be a challenging calendar year. Not just this quarter. It will be a challenging calendar year because at the point that rate cuts happen, A lot of the large banks, with if you look at the exposure to mortgages under the new external benchmark regime, we saw it on the way up, right? That in one quarter everybody reported 40 to 50% jump in NIMs. You're going to see a similar moderation in NIMs when rates are cut. Now, the market is a little bit better prepared for this because when it happened last time, it was the first time after the EBLRs had kicked in, and the quantum of margin movement was not that scary. But even then, I think around that time there will be a little bit of softness in the sector. IT could revive. IT could revive. I don't think there's a lot of downside. IT is more likely to time correct because of the high valuations than actually revive, because a delta on a large cap IT earnings is moves from 8 to 12%. It doesn't move from, if at all, meaning or 5 to 8%. It doesn't really move in a down cycle to 10% and up cycle to 40%. So the even if IT revives, difficult to argue for a major re-rating from here, which is the fundamental. I'm not saying this is a bad year for IT. There is probably be, by the end of the year, the outlook for IT will be better than it is now, and a lot of the fears would have, but a lot of that has been priced in if you look at the valuations.
I want to get another question through to Seshadri. And so you were very contrasting to several other brokerages and analysts. You believe that small and mid caps could continue to outperform large caps this year as well. The concerns in the small and mid caps flagged by some of the brokerages and analysts is that there has been exuberant buying over the last year, and mainly powered by steady retail inflows. If you looked at the domestic mutual fund data over the last 14-15 months, small caps have garnered a lion's share of inflows into equity mutual funds. So do you think that the valuations in small caps and mid caps are tenable, or do you think that there are pockets where there is further scope given that earnings come through?
Yeah, the small and mid cap is a vast universe. And if you notice, we didn't put any targets on the indexes because the indexes actually don't make too much sense because they're disaggregated. They don't represent the small and mid cap space as well as the large cap index does. And more importantly, the forecasts on small and mid cap indexes are not as reliable as large caps, right? And therefore, setting a benchmark target is a little fraught. So we avoided that. We don't think that there's a basis for intellectually rigorous basis for doing that. For sure, there are. You raised a very good question, and it's an eternal debate. Does fundamentals drive inflows, and therefore valuations and stock prices in the small mid space, or is it the reverse? Is it that only when fundamentals weaken do inflows reverse, and therefore the underperformance? I'm a little bit on the latter side. I think you have to wait for fundamental. All the mid cap slumps are preceded by a downturn in fundamentals, which is earning growth, ROE, etc. And I know the worst words in this market are this time is different, but you have to recognize that balance sheets and cash flows in the small to mid cap space are much better than they were at the time of the last slump, say leading into 2018, or when the last SMID slump happened. I do agree, though, that selective stocks where valuations have run ahead of themselves. One facet of the post-COVID market is that it is impossible to make money if you buy even the best company at the wrong valuations, right? We've seen a lot of very high quality companies underperform simply because they got into an overvalued zone, and from there they time correct. It is also true in the SMID cap space, in the SMID space, that there is a very vicious sector rotation, right? You see one sector perform for about 6 to 9 months, and then it goes into a 1-year winter. Then another sector catches up. So one has to be mindful of this. So there will be opportunities in SMIDs, but one has to be careful. But there are still, we put out some ideas which are, some of which are almost all of them are reasonably valued,
Hmm.
and we are, we do believe that you can't split. There's no basket buying or there's no index buying and stuff like that. The essence of SMID investing is that you got to be stock pickers and you got to continue to be stock pickers. As far as uh, flows reversing, see, there's one more. People are looking at the flows into domestic mutual funds as a key trigger. If that dries up, we had a couple of funds, cut off of stock accepting flows and stuff, which I understand because you can't really have the problem that I said, that you can't keep buying the same stocks and hope to once you're in an overvalued zone, you have to stop buying a SMID stock. Now, having said that, uh, we may see a very different cycle this time when the FI flows come in. The sense that we are getting is that it is not so much a large cap based. Typically, FPIs go and pump up and that was the argument made in favor of financial, that when FPIs pump in money, then they will put it first thing into, they will put in financials, and therefore financials will outperform. I think that theory is changing, and more FPIs are looking at a broader index, to a broader universe to invest in, and looking at a lot of mid to small caps. And therefore, even if domestic flows are not that strong, as I said, FY25 could see a record FPI inflows, and that we think would play in favor of SMIDs as well.
Thank you. Thank you so much for your answers.
The next question is from Manoj Kumar. Manoj, please speak up.
Am I audible? Yeah, hello.
Yes.
Yeah, thank you. Thank you, Mr. Seshadri. My question is, you mentioned elections could be a stimulus, next stimulus, and we have the interim budget and later the budget also. So could you please elaborate, so how it is likely to pan out, and as you mentioned, you are overweight, particularly for manufacturing, this two-wheelers and property sector. So what are your expectations? How it is going to pan out? Thank you.
I'm just, before I answer, I'm just interpreting your question. You mean how do I think the key issues for the FI or for the July budget will be? Is that the question?
Yes, yeah, and are you expecting specific measures in the budget, so which could have an impact on a particular sectors? Thank you.
Yeah. So, meaning it's way too early to expect specific measures, and very frankly, that is, trying to predict specific measures is fraught. It's very difficult to get that right. But I can talk about the three broad themes that I expect in the budget, and the future of reform. The first is that I think capex by the government will continue, and will continue at an even faster pace. We are seeing a lot of tax buoyancy. There is the headwind that the government has to meet the fiscal deficit glide path. Therefore, there will be a contraction in the fiscal deficit. But tax buoyancy should address some part to most of that. And there will still be, a huge amount of resources available, and the shift of overall government spending towards capex, away from opex, to the extent possible, will continue. And therefore, a lot of the government schemes that have seen some progress, starting from roads to piped water to power reforms, all of that will continue, and railways, and to some extent defense, all of that will continue, on an even more aggressive scale, because probably the ability to the compulsion on revenue expenditure post budget will be that much lower. The second part is that there are various policies that have started. PLIs is the most obvious one, of encouraging nearshoring of manufacturing. Expect even more of that to come through. Tough to call out specific measures at this stage. Each industry will be and there'll be a lot of attention to detail. But they expect more in that direction, either at the budget or around the budget. The third is, I think, simplification of taxes. That will continue. And we've seen a lot of that. That will continue. Exactly what dimensions it takes is a little early to say.
Thank you. And if you just permit me to ask, how election as a stimulus is likely to, could you elaborate on that? Like elections impact on
Yeah,
say stocks. Yeah.
the spending that the parties do during elections typically result in large transfers to the bottom of the pyramid. In two ways. One is that in some cases there are specific social security measures that are announced before the elections. To be fair, I don't think there will be a large part of that happening. But again, some of the states which went into election in the last 2-3 years have done that on cutting across party lines. So some of that will impact in a delayed manner. The second is the elections itself, right? It was large cash transfers, not cash, but large transfers to the poor. There's a lot of spending. You buy a lot of so there's a lot of spending which happens during, and that's primarily targeted at the poor. So these are two ways in which elections have been seen in the past to act as not a major stimulus, but a small stimulus to the mass spending categories.
Thank you. Thank you.
Any other questions?
Dipankar has a question, I think. He's raised his hand.
Yes, Dipankar, please go on. Please unmute yourself.
Yeah, can you hear me?
Yes.
I just wanted to understand, you just spoke about CapEx is going to be one of the big drivers that could be expected from the budget, and it would be at the faster rate. But I mean, what is your sense about private sector investment? Is it because private sector investment is not there, which is why government has to compensate for it, and they have to increase allocation for capex? And do you see any green shoots as far as private investments are concerned?
I'll answer them in reverse because the second one is easy. Yes, even in the first half numbers, we saw private sector capex moving up significantly. But the caveat there is that if you look at a 15-year chart, private sector capex is at much lower levels than they used to be. If you look at India's history between, say, 2005 and 15, the private sector was involved in many capex-driven industries like infrastructure in the main. Now we all knew that came to an inglorious end because it was debt fueled. The economics of many of those projects did not work out. So private sector capex will continue to grow because the demand is picking up, but it will not reach those levels of 2005 to 12, 13. And that is not in itself not bad. We don't want corporate balance sheet to be that stretched as they were. As far as the driver for government capex is concerned, I don't think it's a false binary that private sector capex, that government capex has to step in because private sector capex is not there. I think both have to coexist. The experience of this century of 2000 to 2015 shows us that many parts of infrastructure building have to be done by the government. And not in India, across the world, so many of those infrastructure investments were neglected. Moreover, there are many sectors which are seeing reform and stuff like that. If you take a slightly longer term view, decarbonization will involve another capex cycle, which again a large part will have to be picked up by the government, and some part have to be picked up by the private sector. So, if you put all this together, I think it is fairly obvious now that both have to coexist. And in fact, in a country which is infrastructure deficit, the government has to do the heavy lifting, at least initial part of the cycle. So again, I don't see it as a binary. I think both have to coexist, and the government will continue to have to do the heavy lifting. But if you look at the trend in private sector capex, it started to accelerate. It will continue to accelerate, and the momentum, I think, will pick up as we go along over the next few years.
Okay, so we have two more questions. One is from Anshul and one is from Sakshi. So we'll have Anshul's questions first. Anshul, please speak up.
Hello. My question is about, sir, you said there are no major risks to earnings for now. So that means you don't see any risk from what's happening in Red Sea. You don't see any increase in freight charges, or how do you see that pan out?
Good question. So far, the impact of Red Sea is not that acute. But that's one risk that we are watching out for. Whether it plays out like a post FY23, post Ukraine war kind of scenario where there are significant supply chain disruptions and margins take a beating. That is a risk that we are. But so far, it doesn't seem to have impacted the overall Middle East. We did a note, I think, on this some time ago. That the overall Middle East situation is a cause for worry, but ever since it has broken out, the impact has not been as acute as one thought it would be. Admittedly, and you raise a very good point, that in the last 10 days, the situation has worsened. Both Red Sea now, I think Iran and more and more countries are getting pulled in. But it's a situation that we are watching, and that is incrementally a bit of a worry. But so far, supply chains in major raw materials have not been disrupted, nor have exports not yet. But it's something worth keeping an eye out on.
Okay, thank you.
Can I go ahead?
Yes, please.
All right. Good afternoon.
Good
I
afternoon.
have a rather broader question. So this year, of course, a lot of important events are lined up, right? Spoke about the budget, election, rate cuts, all of that. And frankly, not just at home, globally as well. A lot of countries going to elections this year. So I want to understand, can we expect a lot more volatility in the market on account of these factors? Because like you rightly mentioned, right, markets do not function in a linear manner. So yeah, that, and if yes, what would be the intensity?
Can't quantify the intensity, but yes, it will be a much more volatile year. We're going into the year hot. We had a very strong end to the year. That usually raises volatility, and most of it will be seen in the first quarter and a little bit in the fourth quarter. But your answer is absolutely right. There are also major, as Anshul also asked, there are also some geopolitical challenges around the world. So yes, we expect while it is while we do expect an 11% return, and we've already flagged that it will not be linear if you look at it quarterly. But intra quarter, it will be probably a much more volatile year than it has been.
Okay. If I could add one more question to that, why do you see the first and fourth quarter? I understand seasonally how things are and all of that. But given that most of these events are lined up in the second and third quarter, right? Shouldn't we see more volatility in those two quarters then?
Yeah, if we had nasty surprises, yes, we will. But I'm not expecting. I think those are reasonably predictable events by and large. And I think other global elections don't impact Indian markets as much.
Okay.
So the three key events that are the Indian elections, the Fed rate cut, and the RBI cut. So if something when the Fed rate cuts gets postponed, for example, you will see a little more volatility for sure.
Okay. And when we see these occasional falls, right? What is the role of foreign portfolio investors in that? The outlook
Sorry,
on that.
could
These
you? I missed the
when we
first part of.
see when we see these occasional falls, right, in the market, for example, something like what we saw yesterday. So I want to understand the
Okay, on a day-to-day basis or on a short-term basis, very tough. And again, we've seen often enough that it's not a linear relationship, absolute 100% one-to-one relationship between FPI flows and the market performance, right? I mean, FPIs could buy and the markets could underperform for a while before it turns. So tough to answer that. Will the FPIs be buying every dip? Not sure. Sometimes they may be selling the dips and buying the ups. I think anybody's that good in being perfectly contra to the markets. But by and large, I don't think they will be faced by short-term volatility, if that is your question. They will, the way it works is if there is increased emerging market allocations because the world is going, because investors globally are going risk on and therefore looking into emerging markets, then they will see very strong flows into their India allocations because India, as I said, is getting a much larger share of emerging market than they used to, both from a positive situation where India is now seen to be a very, very strong investable market. And from a negative perspective, if I may use that word, because a lot of people are looking at alternatives to China. So if you combine those two, India will see a larger share of emerging market flows, and then FPIs will invest through volatility. They will not be faced by volatility in the markets.
All right. Thank you so much.
So there are a few questions in the chat box, which I'll read out, sir. We have a question from Janki Krishnan. She asks that last year we saw a lot of PE exits. So do you think the momentum will be sustained this year as well? And what kind of equity returns you expect to be front-loaded in the first half of the year? Could you elaborate a bit more on that?
PE exits, if the market is strong, will continue because their funds close, they have exits, they want to list the companies. Ultimately, they have to look at an exit to the market, right? To their investments to realize return money to their investors. So actually, if the market is very weak, that is when PE exits will be relatively sluggish because they like to exit at good valuations. And also the absorptive capacity of the market slows down if the markets are very weak. We don't expect first half bunch returns. We expect returns to be bunched in the middle of the year between April and September. First quarter will be weak and the fourth quarter will be weak.
Right. Then we have Srivats Krishnaswamy. He asks, this calendar year you said we'll see record FPI flows. So do you see the flows in equities to be more than anticipated FPI flows post India's inclusion in the global bond index June this year? Or is there some kind of correlation to that? And also if you could elaborate on why it could be a record.
Yeah, so one small correction, the record we expect for FY25, so between April and March. We expect that because if there is a rate cut, Fed rate cut, we see a global risk on flows coming through. So allocations to emerging markets will pick up. And as I just said, that India will get a much larger share of FPI flows than they used to. So if there is a global risk on, we will see very strong flows. Why I expect it to be record? Because when the last record was achieved in an FI basis, it's in FY21 again, accompanied by, to be fair, much larger rate cuts than what we anticipate this year. But India was a much smaller market in terms of market cap. Today, the market has a much greater absorptive capacity, and China's not relatively weaker in the equation. So you combine those two, I think the FY21 record could be broken. As far as India's inclusion in the global bond, that's separate. The inflows that will come, I'm talking about equities being a record. The bond inflows could be, is an additional factor that will play for India.
Okay, so Deepak Mondal, he wants to ask you if you concur with the RBI governor's prediction of a 7% growth rate in FY25.
I don't get into economic GDP forecasts, very frankly. It's more Madhvi's domain, who's our economist. I don't want to put a number in terms of growth, but do I expect very strong GDP growth in FY25? Yes, I think the momentum will continue. We are in a multi-year high GDP growth phase, and as Nirav we are in a golden period as far as macroeconomic stability is concerned. All that is that is the groundwork, and then India's demographics and relative attraction from a global perspective will play out. So I won't litigate numbers on that, but do I expect very strong growth over the next 2-3 years on a continuous basis? Yes, I do.
Okay, and Falaknaz wants to know your outlook on the rupee, crude, and bullion.
Okay, I don't make bullion forecasts. Rupee, we think, should be stable. My prediction is that rupee should be stable through this year, because while there may be maybe some pressures on CAD, but CAD from a historical perspective is quite weak, and the capital account should be very strong, because both equity and debt should see very strong. So we would see a flat to a mildly depreciating rupee. Crude, very tough to call, but I think crude should be soft if the global scenario plays out. Unless the Middle East crisis escalates into a serious situation, I think crude should remain fairly weak. I think the Bloomberg consensus has it flat, but I think there's downside risk to that as well. Gold, if it's okay, I will skip making that forecast. That's not my area of expertise.
Okay, so if anybody has any questions, please feel free to raise your hand or type in the chat box. We'll wait for a couple of minutes, just in case, else we conclude.
Okay, I don't think there are any further questions. So thank you everyone for joining our media roundtable. In case you have any questions at a later time, you can write to us directly or through Whitemark Solutions. And we would shortly be rolling out the press release and the report which Seshadri was referring to. Thank you once more. Bye.
Thank you everyone for attending. Thanks to taking the time out.